Hi, everyone, and welcome back to Your Finance TV. As always, here on Fridays, we've got Jay Pelosky back with us. How are you, Jay?
Good, Scott. It's been a busy one so far. We've even had an earthquake in New York City, so I mean that's pretty rare. But here at TBW Advisory, man, we're holding down the fort, trying to get our monthly done.
Well, listen, I tell you what, like I was in the car when it happened, so I didn't feel anything. But the title of your musings of the shape of things to come, I hope we don't get any more earthquakes. But run us through the title.
Yeah, exactly. I hadn't even made that connection. Well, we had the pleasure of being on that other channel, Bloomberg, on Monday to guest host, and as usual, that uh, kind of TV time where you have to talk in 30, 50-second sound bites really helps clarify one's thinking. And so we had an opportunity to engage in like a 10 to 12 minute opening dialogue with the co-anchors. And it really, kind of allowed us to lay out our thinking. And basically the bottom line is, as you know, and viewers know, we've been constructive for ages, since the summer, fall of 2022. And our short-term kind of positive tactical framework has been adopted by others, right? I mean, we've had very strong S&P run. And if you haven't turned positive, you're probably out looking for a job. So that's kind of okay. That's how markets work. But we want to continue to focus forward, right? Our big belief is that one has to focus forward to be able to compete with forward-looking discounting markets, that we are charged to do exactly that, compete with them and compete with others and trying to understand where the puck is going. So we want to extend our thinking. We want to look into the out years. And so we're basically making the case that the shape of things to come is a period from 2023 to 2027, syncing it up with our preferred historical analog, the 90s, second half of the 90s, 95 to 99 in the US. And we see a period of kind of blue sky, solid macro environment, good for risk-taking assets. We believe we are early cycle in a global economic recovery. Remember, surprise number 4 and our four for 24 macro surprises. We believe that recovery is going to be underpinned by a synchronized global rate cutting cycle, abundant liquidity, better productivity, which will lead to sustained corporate margins and positive earnings growth, and good risk return, good risk asset returns. And so the two real areas of opportunity as we see it are one, in the commodity space, which again, we've been positive on and overweight for a considerable period of time. But we believe if this positive blue sky outlook comes to pass, we are in the very early innings of a commodity up move. And you can talk about the decade long base in energy, or the 13-year base in gold, or the 17-year base in copper, all of which to suggest that we are most likely early innings in the commodity opportunity. And particularly if we get a weaker dollar, which we expect. And we note that even with the rate backup of the last week, DXY is not strengthened at all. In fact, it's weaker over the course of the past week. The second opportunity, and then I'll stop, is in the tech stack divide that exists between the US and China. And this is really something that we're becoming more and more keen on, basically arguing that everyone knows the US wants to freeze China out of the high-end tech stuff. But at the same time, China is saying, okay, if you're going to do that to us, then we're going to freeze you out of our domestic market. And so you see Apple as an illustration, right, off 15% from its recent high, in part because it's likely to be the poster child if China is actually successful in closing off its tech stack opportunity to U.S. companies. And so to put it very, very plainly, you're talking about a tech stack that is in a population of 1.4 billion with an economy that's almost the size of the U.S., second biggest in the world, growing at 5% per annum, with an e-commerce market that's twice as big as the U.S., with tech stocks that are selling at about a 70% discount to the US, Alibaba, 8 times earnings, Tencent, 14 times earnings, in which, by the way, just like the US companies, the big China tech companies are cash machines. And so they're buying back stock aggressively. Alibaba in the last fiscal year, which ended on 3/31 for them, bought back 5% of their outstanding stock. They spent $5 billion buying back stock in just the last quarter alone. And so to us, that really speaks to a significant risk asset opportunity. So those are the two things that really right now, amidst the US that's close to all-time highs, pulling back maybe 1% or 2% here, we really see the opportunity set for new money, or if folks have, they've made a lot of money in tech, they're looking for where to put it. We think China tech is a very interesting opportunity, and we think commodities across the complex are very interesting opportunities as well.
Well, for not our new viewers that are on here today, this is a monthly breakdown. So Jay breaks this down into different sections of climate, economics, politics, policy, and markets. So we're going to jump straight into it for you, and we're going to jump straight into climate. And what are you seeing in the climate side, Jay?
No, yeah, exactly. I mean, you're a veteran, Scott. You rolled those out even better than I could. So thank you for that. Yeah, you know what's interesting about climate is that it's joining tech on kind of the battlefield between the US, Europe, and China, right? Because everyone needs to kind of meet their climate objectives. But the fear is that the only way they're going to be able to do that is if they allow the Chinese companies, particularly in renewables, but also increasingly in electric vehicles, to dominate the space, right? So you have already Chinese solar and wind turbine producers pretty dominant globally. You have the EV makers like BYD starting to really penetrate the export markets of the US and Europe. And for example, BYD is talking about setting up shop in Mexico to produce there, but sell into the United States under the US, Mexico, Canada trade agreement. They're also talking about setting up a production platform in Hungary, which is creating a lot of unease in Europe. And so this space is really one that we are focused on, watching these two battles, the tech battle, the tech stack divide, as we call it, and the clean energy battle between countries' desire to meet their objectives and the fear that the only way to do that is to allow Chinese companies who, for all the talk about them being Maoists and communists, are pretty effective capitalists, because BYD, for example, is selling its electric vehicle at the same price as an internal combustion engine car, whereas in the US, those prices are almost double. EVs are almost twice as expensive as a basic internal combustion engine car. So it just gives you an example of how competitive these companies can be. And so that's really the stuff that's going on in climate. Again, kind of a big tussle between Chinese companies, which are increasingly dominant. BYD is dominant in China, dominates Tesla, starting to really come out into the global marketplace, and how that's going to play out is really something to watch.
Okay, so let's move on to economics, and we'll get into the show next week on this, on the CPI print out next week. But jobs data was out today, and I've got a little bit of a stat for you from David Rosenberg, who I used to work with at Merrill Lynch back in the day. He was saying that outside of part-time jobs, self-employment, and multiple job holders, employment actually contracted about 500,000 in March, and by about approximately 200 million in the past year. I don't think that goes along with your thinking, though, right?
Yeah, no, our view of the shape of things to come tends to be very different from Mr. Rosenberg's. We tend to take the bullish side of things, the positive glass half full view, and he is known for the negative, bearish, glass is half empty, if not completely empty, with a hole in the bottom type of view. So, look, our focus on the economic side is not jobs nor inflation. Thank you very much. Our focus is on what we see as the first stirrings of a global manufacturing upcycle, which we think is much more important than either of those other two issues. We've beaten the CPI conversation to death. Jobs are the labor force is fully employed, and that's, in our view, going to drive productivity, which is another part of our economic outlook. And so right now, though, what we're focused on is the fact that in the last week, manufacturing PMIs in China and the ISM manufacturing PMI in the United States are both above 50. In the case of the US, that's the first time the ISM's been above 50 since the middle of 2022. It's one of the longest streaks of that indicator being below 50 in decades. And so to us, that's the big deal. That's the big story. Manufacturing, after years of being in the doldrums, because you had that whole COVID supply chain craziness where, you know, no one could get goods and everybody produced a ton of goods and then there were too many goods. And so all that has been unwound. Inventory to sales levels back to where they should be. And we think we're at the beginning of a global restocking cycle, global manufacturing upcycle, which is going to be sustained by the fact that you have full employment, you have record wealth gains in the United States, you have record household savings in China, you have full employment in Europe, and this is going to drive consumption, which is going to sustain manufacturing. And at the same time, as I touched on, the fact that that populaces are fully employed in Europe, in the United States, you have demographic pressures in Japan, in China, means that productivity gains could be quite substantial in the coming years. And we note in our monthly that McKinsey just came out with a global productivity outlook, and it's quite constructive. And so we think that's pretty good company for us to be with. And so to us, the shape of things to come is likely to be a period of solid economic growth, moderate inflation, which is going to be kept moderate by productivity gains, which should also serve to support corporate margins and hence profitability, earnings, and risk assets.
Let's move on to politics. And I've got a little bit of scary news for you on your theory about Biden. Dwayne "The Rock" Johnson is not endorsing Biden this year. Is this going to change any of your views, Jay?
God, you're pushing back hard on me, buddy. Two in a row. You're giving me two in a row with David Rosenberg and The Rock. Well, I don't know. I mean, that's tough competition. But no, we're staying with our view that we expect President Biden to win in a landslide. And we've talked about the reasons why many times, so we're not going to go into that. What we will talk about, though, is that the concerns that former President Trump could return to office are starting to really shape discussions outside the United States. And so two quick examples. One is in Europe, where the Europeans are contemplating joint borrowing to boost their defense spending to protect the Ukraine, given that the U.S. is in political gridlock and unable to pass Ukraine legislation. There's also talk within NATO of forming a NATO-wide fund and having NATO take control of armament distribution in the Ukraine from the United States because of fears of what former President Trump might do in regards to NATO. Remember, he wanted to take the U.S. out of NATO. in his first term. So there's a lot going on in Europe trying to start to really protect itself from former President Trump should he return to office. And from our point of view, remember, our whole thesis is regional integration, the tripolar world in Europe, Asia, and the Americas. So former President Trump is a driver to regional integration in Europe. It's also a driver to regional integration in Asia, where we note that recent polling in Southeast Asia suggests that the Chinese political model, not economics, but political model, is becoming more popular than that of the United States. And that is a big change. Obviously, with China being in Asia, China is going to be the dominant economic player. But politically, that the Chinese political model is having more appeal within Southeast Asia than the American political model is something that really stood out to us as a very worrisome sign of kind of where America's standing seems to be heading in a very important part of the world. Southeast Asia is going to be the fastest growing, most vibrant economic neighborhood or region in the world, and we want to maintain influence and importance there. And so that's another worrisome sign on the political front.
Let's move on to policy, and obviously we've had a lot of speakers on the road this week. One comment I did see was from David Einhorn. One, he was still worried about inflation, but he also wouldn't be surprised if we saw no rate cuts this year, which I find very surprising in an election year. Surely you're going to see at least one.
Yeah, well, let's remember that typically the Fed does not cut in election years. It's very rare. In fact, I believe the last time and one of the few times it's done so was in 2008. And let's remember what was going on in 2008. It was a pretty ugly market environment, not like today's, thank goodness. But again, we are not focused on the Fed. We had the same topic of conversation Monday on Bloomberg, where they rolled out how many Fed speakers there were going to be this week. And they asked what was our point of view. And I said, we pay virtually no attention to the Fed. Virtually no attention. It's in the past. The market is telling us clearly as it can possibly tell us that it is happy to trade rate cuts for strong growth, right? Rates have backed up dramatically over the last week. What's the stock market done? Perfectly fine. Why? Because rates are backing up, because growth is going to be strong. So the Fed and markets have come together coalesced around the 3 rate cut environment. Maybe it's 2. I agree with you. I think they'll cut at least once or twice, because if you look at their measures, monetary policy is very, very tight. We have real rates of like 3%. And so that's historically very, very tight. So whether they cut in June or whether they cut in July, I don't think really matters. What we're focused on policy-wise is how strong the fiscal stimulus has been in the United States. And there's a lot of work that's come out in the last year or so showing how much stronger the post-COVID growth has been in the United States versus any other of the G7 countries. And it's down primarily to fiscal stimulus together with immigration. 2 of the bugbears of the Republican Party, right? Immigration is like the absolute bugbear, and fiscal spending, likewise, not really something that Republicans traditionally have been supportive of. And yet, that has been the big driver to the U.S. performance. We think that's going to ebb in the next year or 2 in the United States, but importantly, pick up in Europe, where a lot of the spending that's been allocated for climate and energy independence and things of this nature have not yet been spent. And so when we look at Europe today, not only is the southern tier of Italy and Spain, Portugal and Greece doing better economically than Germany, which is itself quite unusual. But we think that's going to continue because a lot of that fiscal stimulus, a lot of that spending, that EU-wide climate spending, is going to be done in those countries. And so we're constructive on fiscal stimulus in Europe. We think it's going to ebb in the United States. It's been a key driver. It's going to ebb in the next couple of years, but we have other things going on that's going to support the economy in the U.S., namely that wealth effect and manufacturing and regional integration. And then we look at Asia, where, if China were to employ fiscal stimulus to boost consumption, basically transfers to consumers to get them to spend, that would be a real game changer. You would see commodities absolutely rip if anything like that were to take place. I'm not sure it's going to. China is growing. JP Morgan just raised their Q1 GDP forecast to 6.6% annualized in China. So they may decide they don't need to do that. But if fiscal stimulus was really brought to bear in China, it would be an absolute firecracker to the commodity space.
All right, and let's wrap it all up with markets. And in the US, thankfully, Joe, we survived the 2-day sell-off of April 2024. I hope that everyone survived it. Like the CNBC panic merchants really got everyone going. The streak of no down days of 2% or more continues, and the buy the dip players continue to succeed. So, Jay, what are you thinking on markets?
Yeah, no, that's you're absolutely right. I mean, it does feel like a big deal because we've had such a long run of pretty quiet markets, which again, as a gentle reminder, our macro surprise number 3 was return to stability. And we talked about how we thought the VIX and the move and other things were going to really calm down. And that's exactly what we've had happen. And so now we have a little blip, and that's good. That's healthy. That cleans out some of the, bubble talk. It cleans out some of the crazy option activity that takes place when people get, kind of overly confident, shall we say. But from our perspective, again, kind of meaningless. We've been positive on risk assets, as we touched on in the beginning, since the summer of 22. We remain positive. We are overweight equities, overweight commodities, deeply underweight fixed income, no U.S. Treasury exposure at all. And remember, our benchmark is 40% Barclays Ag, so massive off benchmark bet on the fixed income side because of our view of early cycle global economic recovery. We don't see the case for bonds. We like credit. We like high yield in the U.S. and in emerging markets. We like within the equity space, we want to continue to be with the leaders, which is tech and cyclicals. Again, cyclicals telling us very clearly, listen to stocks, not commentators. Cyclicals telling us very clearly in the U.S. and globally, we're early cycle. So we want to stay with the cyclicals. We want to be in the laggards because a lot of stuff is run. What hasn't run? Small caps. What tends to do very well in the periods after the ISM breaks above 50, after a period of being under 50? Small caps do well. So we're overweight small caps in the U.S. And then outside the U.S., we continue to be positively disposed towards Europe and Japan, but really see the opportunity in this shape of things to come, in this multi-year period of blue sky macro outlook, solid global growth, early cycle global growth. We want to be in emerging markets. And so we continue to see the real opportunity in China. We've touched on that. We continue to use the TPW regional integration plays, overweight Mexico, overweight Poland, and we continue to think that Brazil is interesting, even though it's been a laggard year to date, basically flat year to date. So those are really the views. We want to stay long the commodity complex. Copper, which we've talked about many times recently, copper's up almost 20%. COPX is up almost 20% in the last month. That follows uranium, which had a 25% move in December and January. These are moves where people are really offside and they got to quickly get onside. But we think it's the beginning of the move, not the end of the move. So we're staying long energy, long copper, long gold, long uranium. All of those are in our global multi-asset model portfolio. So, to us, we're pretty constructive. Pullbacks are good. That's fine. Not anything to really worry about. The last thing that we would say is that we are increasingly thinking about the opportunity set in the thematic space, which has really been left for dead over the last couple of years. So here we're talking about fintech, biotech, cyber, robotics, that type of thing. And, the old trader adage comes to mind, right? The wider the base, the higher in space. In these sectors, these thematics, kind of like the commodity space, the bases are pretty wide. And if we do have a blue sky period ahead, some of these thematics are really going to work. And we're continuing to really start pay attention and digging into some of them with a little bit more interest than maybe we had, 6 months ago.
Well, Jay, thank you very much again for this monthly breakdown. I know you're going to have a nice, relaxing weekend, so you don't have to watch any Duke basketball or anything like that. So you go get yourself a nice rest and take it all in easy this weekend.
Thank you, Scott. I do plan to be watching some of the basketball tonight and tomorrow night. It's just been awesome to watch the explosion and interest in women's basketball. And so plan to watch a little bit of that tonight. And then tomorrow, probably watch, but nowhere near as much interest as if Duke were to be playing either tonight or tomorrow night. So you have a good weekend as well. And thank you for the opportunity to talk.
Thanks, Joe. And for everyone else out there, good luck investing.